Loretta Mester, the Cleveland Fed President, as you say, Scott, says it's appropriate to cut rates later this year if the economy evolves as she expects. She says there has been substantial progress on inflation, and she expects that progress to continue. In fact, adding the inflation picture in her mind hasn't really changed much despite those recent firmer readings we got in January and February. She doesn't or had expected inflation progress to slow, so what she saw the last 2 months was very much in line with what she expected. The most likely scenario, she says, inflation continues to decline towards the 2% target over time. Now, she's not quite ready to cut just yet, saying she needs to see more monthly readings on inflation, quote, to raise my confidence. Does not expect to have enough by the next meeting, enough confidence, that is, or enough data. Now, she does say the risks are coming back into better balance, but points out that the bigger risk right now is cutting too early. If inflation, she says, expectations come down, not cutting would amount to a tightening. So that's a bit on the dovish side. She does see higher inflation this year than the median Fed forecast out there, which is 2.6%. And she acknowledges that her neutral rate is at 3% compared to the median at 2.5%. I will point out for your edification there that there are now 7 members of the FOMC who are at 3% or higher for the neutral rate, and that compares to 4 back in December. She says the risks include heightened geopolitical tensions, slowing growth in the Chinese economy, and of course, on the other side, stronger than expected productivity growth. Real quick look at the probabilities. They had been at 59% for June. I'll just double check that remains the case after Mester talks. Yeah, that's just about where it is. You can see that June's a bit in play right now compared to how it was. And then you look also at the Fed funds for the year end. It's 466. So right in line, even a little bit more hawkish than the Fed is tomorrow. Scott, I get to talk to Raphael Bostic, the Atlanta Fed president.
You feel like, though, Steve, before I let you go, that the bar is increasingly growing higher for June?
Yes, I think that's right. I think that it is higher. My real concern right now is whether or not, given what y'all have been talking about, the higher commodity prices, higher oil prices, whether or not that feeds into two things. One is inflation expectations, and the other is the March inflation data that we get in April that's going to maybe set the count back again. Everybody keeps saying, well, Waller said a couple months. Mester says she needs a few more months of data. That, you know, if you get that constant data that doesn't show the improvement, we got to start counting again. So that's why June would be in play, or not necessarily a slam dunk for that rate cut, because I don't expect, or I'm not confident, we're going to get more progress in March.
Steve, I appreciate it as always. Steve Liesman, our senior economics reporter. Jim, I keep hearing, we don't need rate cuts. Economy's great. That trumps, rate cuts. JP Morgan today, their trading desk says the bull market can continue without them. Wolf Research, good chance of 0 rate cuts. What about that notion? Whether we need them or we don't, the market talked itself into a pretty dovish and happy place, thinking that, hey, the economy's great. So what if now 7 has gone to 3, and now maybe 3 is going to go to 2, or maybe 2 goes to 0?
We don't need rate cuts. That's my position. I'm not counting on it. And I'm not being blasé either. Look, this is about a strong economy. This is about profits, which Surratt was talking about.
So you're in the camp that I was just talking about.
That's why I answered the way I did. I was expecting a little guffaw, but I didn't get one. I'm hurt. Look, this economy is very strong, and the sine qua non is that people are employed. When they're employed, they consume. Whether it's buying houses, which is showing green shoots, whether it's the manufacturing ISM that's indicating that inventories are being restocked because people are buying things, whether it's people traveling, airline traffic is still very, very high. All right, people are employed, and for all of the worry that the long and lagged effects of 550, whatever it is, basis points of rate hikes by the Fed would knock that down, we're now 2 years past the initial rate hike. If those long and lagged effects were going to happen, they would have started to happen by now. They're not. They're just not. What is happening, though, is the markets overall are coming to grips with the fact that a recession is not likely, could happen, not likely. And if it doesn't happen, then all these cyclical and value companies are likely to continue their good profit streaks and continue to catch up to the tech darlings. Now, could we have a pullback? Of course we could have a pullback. We're due for one. It would be healthy to have one. Scott, and dear viewers, I'd be surprised if you get more than 7%. I think 5% down, you're going to see the fear of missing out come in, and people are going to start buying because a lot of people have sat on the sidelines as this market has taken off.
How much of this rally from the October lows has to do with expectations of rate cuts? And now you're going to tell me that we don't need any, and if we don't get any, that everything's going to be just fine. You're telling me that, why do you think the small caps are down 2% today? Why? Because rates are up. Trades that were working or theoretically were going to work because of the prospect of rate cuts, you can't now tell me that, well, they're still going to work even if we don't get any rate cuts.
Well, no thesis is perfect, right? So you point out the small caps, and that's very hard for me to answer, but I think there's obviously a larger universe above small caps. If you look at the S&P 500, just a general barometer of the stock market, what's it off? 1.5% from its recent high. And as Scott, you're pointing out, we started the year expecting not me, not Surratt, not Josh and Bryn, but the market was expecting 6 rate cuts. Now we're down to maybe 2 or 3. I mean, June looks like it's getting pushed out. This market is accepting it. This market understands. It's not about rate cuts. It's about employment. It's about profits. It's about a strong economy, all of which you have.
Bryn?
Yeah, well, I mean, you touched on it, but the market is not this monolith, and you absolutely will have sector rotation. And I know there's been this obsession with small caps for the last 3 or 4 months of everyone's go into small caps. And to me, that's such a narrow band that you have to have so many things work out. And so I think you're going to continue to see small caps, value and growth lag the market as we're going through this, are we or are we not going to have these rate cuts? Because don't forget, we're going into an election, and I don't think the Fed wants to be present cutting rates in the few months coming up to the election in November. And so I think that their sweet spot, if they're going to cut rates, they're going to do it this summer. But after that, I think they're going to be more neutral. And so I think that as an investor, if you think we're going to be higher for longer, you absolutely need to understand what your positioning is, because there will be the haves and the have-nots. I don't think AI cares about rate cuts. I don't think certain cyclicals. And also, Scott, on top of this is we have a really good economy, but why is that? I mean, this year in the federal budget, we're going to have a $1.6 trillion hole. So it's not like we're just zooming along by ourselves. We are being juiced up from the fiscal side, and I think that's also a reason why gold. Yep. Why I know, but there's unintended consequences, and so why gold and why yields will continue to make investors nervous, because when people start doing the math on interest expense, and we can say we're the reserve currency and it doesn't matter, but at some point it will matter to markets if we keep juicing the economy from that side.
Josh, I mean, Jim says, rates are up in the market. He used the words, the market is accepting it. I would suggest the jury is still out. I mean, we're in the midst of a backup in rates. If you start getting above 4.4, right, we hit that, and then you start moving closer to 4.50 once again, that may be tested.
You know what's so funny about that, Judge? I'm old enough to remember when 3% was the level we couldn't get above in the 10-year. That was like a no-go zone for stocks. And then we added 5,000 Dow points immediately after crossing through it. So, yeah, I'm sure there's a trigger somewhere out there where people say, oh, you know what, actually, I'm going to make a huge allocation shift. I don't know if it's 450. So I wouldn't get caught up in that conversation, because if we go back and play the tapes, that's really not been incredibly helpful.
It's not the number. It's not necessarily too. Okay, I'll grant you that. I guess my point is it's not necessarily a number. Dow down 501 points as I asked you this question. It's the idea that rates are not going to do what we once thought they were going to do. And part of this move in the market was predicated on the fact that rates were going to do what we thought they were going to do, and that's go lower. So at some point, you're going to have an issue. What's that?
But why? So, rates are not going to do what people thought they were going to do, but why? If the reason why is because we're seeing, re-accelerating inflation and some sort of an emergency where the Fed has to pivot, that's really bad. I don't think that that's currently what's being repriced right now. If the reason why we're not getting 6 rate cuts or 4 or 3 this year, or that it's not June, it's July, is because the data continues to be strong, I think to Jim's point, he used the word I wouldn't have chosen. He said the market's accepting it. But to Jim's point, I would say the market can tolerate it. And that's a really big difference.